This is an Uncovered Japan Company research report on Chikaranomoto Holdings, the company behind IPPUDO, ticker 3561. IPPUDO has carried Hakata tonkotsu ramen from Fukuoka to a network of 317 stores across 16 countries. In this video, we will examine the global brand and vertically integrated model, the recent pressure on overseas profitability, and what the valuation requires investors to watch next. The report snapshot shows a forward price-to-earnings ratio of about 25 times, return on equity of 16.1%, and a 60.3% equity ratio. Overseas operations generate 40% of group sales, the highest overseas sales ratio identified among listed Japanese restaurant chains in the report. The shares are not obviously cheap, so the investment case depends less on multiple expansion and more on proving that the international network can grow profitably. What customers see is a bowl of IPPUDO ramen, but the operating model is broader. Chikaranomoto owns noodle manufacturing through Watanabe Seimen, operates restaurants, supplies products to business and retail customers, and licenses stores in Japan and overseas. That vertical integration supports consistent quality, product development, and a gross margin near 70%. It also creates a high-margin product sales business alongside the restaurant network. The top line has been strong. Revenue compounded at roughly 17% a year over 5 years and reached a record 36.3 billion yen in fiscal 2026. But operating profit peaked in fiscal 2024 and then declined to 2.3 billion yen. The consolidated operating margin fell from 10.4% to 6.4%. This gap between revenue growth and profit conversion is the central financial tension in the report. The three segments have very different economics. Domestic stores are 48% of sales, at an 8.3% operating margin. Overseas stores are 40% of sales, but their margin has fallen to 6%. Product sales are only 12% of revenue, yet they earn the group's highest displayed margin at 12.7%. The opportunity is to restore overseas profitability while continuing to compound the smaller product business. The report identifies 3 durable advantages. First is the 40-year IPPUDO brand. Second is vertical integration, especially in-house noodle manufacturing, which supports quality, cost control, and product development. Third is a licensing model that covers 96 of the 317 stores and reduces capital requirements in part of the network. The unresolved tests are pricing power, after holding prices since October 2023, and whether the overseas operation can convert brand reach into better margins. Chikaranomoto's 144 overseas stores span 16 countries across Asia, Oceania, North America, and Europe. Thailand is the largest single market, but no country exceeds about 17% of the overseas store base. That breadth reduces dependence on one geography. It also creates operational complexity across currencies, labor markets, security conditions, and consumer habits. Diversification is a resilience advantage and a near-term margin burden at the same time. The balance sheet has changed dramatically since the pandemic period. The equity ratio rose from 24.8% in fiscal 2022 to 60.3% in fiscal 2026. Return on equity normalized from the mid-20s to 16.1%, still a healthy level. The report describes the company as effectively near net cash. That financial strength gives management room to invest, but it does not remove the need for overseas projects to earn acceptable returns. Operating cash flow peaked with earnings in fiscal 2024. But free cash flow has remained close to 1.5 billion yen for 3 years. Fiscal 2026 operating cash flow was 2.78 billion yen, with free cash flow of 1.55 billion. That record supports the dividend and selective expansion. The indicator to watch is whether continued international investment preserves this cash conversion, while overseas margins recover. Management's fiscal 2028 vision targets 50 billion yen of revenue and 5 billion yen of operating profit, up from 36.3 billion and 2.3 billion in fiscal 2026. The report says the plan relies heavily on overseas expansion, alongside licensing, halal and plant-based formats, and productivity improvements. The challenge is that fast store growth and margin recovery can pull in opposite directions. Overseas sales and operating margin must be assessed together. At about 25 times forward earnings, Chikaranomoto trades a little above its 5-year average of 22.7 times, and close to the restaurant sector median used in the report. That is a fair quality valuation, rather than a clear bargain. It gives credit to the brand, growth, and balance sheet, while demanding evidence that profit can catch up with revenue. Overseas margin, same-store performance, and pricing decisions are the most useful checkpoints. To conclude, Chikaranomoto owns a rare asset, a Japanese restaurant brand with genuine global reach, supported by vertical integration, licensing, and a rebuilt balance sheet. The report is equally clear about the trade-off. Revenue is growing, but overseas profitability has weakened, and the current valuation assumes that execution improves. For the complete evidence, assumptions, risks, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.